Hello everybody, thank you for joining us on this webinar. Hopefully everybody can see me and they can see the slides. One of the difficulties about presenting a webinar is I can't see any of you, so I don't know whether you're paying attention and whether you can actually see or you're listening to what I'm saying, but hopefully everything will come through clearly. What we want to do today is go through some of the general VAT issues that you need to consider in the cultural sector, and then my colleague John Daly will outline some of the gift aid and tax implications of what I'm going to be covering. In terms of the agenda, there's a number of areas that we're going to go through. Hopefully these will come up on your screen now. We'll be looking at the temporary 5% rate that's been introduced for admissions, hospitality and accommodation. I then want to go back over some old ground on the cultural exemption. And actually the importance of monitoring this, because we've come across a couple of situations now where, unfortunately for the organisations, they've found themselves unwittingly liable to VAT because they haven't applied the exemption properly. I then want to update you on the Royal Opera House case and where this has got to. And for those of you that are not aware, this is all about the recovery of VAT on production costs. And then cover some general updates about cash flow ideas that you might want to think about during this COVID crisis and this new way of working, an update on e-publications and digital advertising. And then we'll round off with John covering gift aid and other tax considerations for you. So they're the areas we're looking to cover. If we move over to the next slide, and we'll start off with the temporary reduction of VAT. The Chancellor, very helpfully for a change, on the 8th of July announced a temporary reduction in the VAT rate from 20% to 5%, all sounding like good news. Unfortunately, for those of you that have to complete VAT returns, the dates are smack bang in the middle of a VAT return period, so the reduction is going to apply from the 15th of July 2020 to the 12th of January 2021. And it applies to admissions to attractions. So the first question there is, what is an attraction? Holiday accommodation and sales of food and non-alcoholic drinks. Note I've said non-alcoholic in the front of that, so no celebrations, please. If we move on to the next slide and see what admission actually means. As you can see, it tends to cover practically everything you can think of there. So we've got shows, theatres, circuses, fairs, concerts, museums, cinemas, other cultural events, attractions, botanical gardens. So it's quite wide. The one thing it doesn't apply to, unfortunately, is sporting events. So there I was thinking, hopefully I'll get a nice reduction for my football season ticket next year if we ever get back to watching any football live. Unfortunately, it doesn't apply to sporting events. For those organisations that are currently applying the cultural exemption, so your admission fees are exempt, they continue to be exempt. The 5% doesn't apply if you're applying the exemption. Now, one of the questions we've been asked quite regularly since the introduction of the 5% rate is, what about tickets sold in advance? So if you sold tickets before the 15th of July, but the event is actually taking place during the reduction period, what's the VAT liability? Unfortunately, because you've sold those tickets before the 15th of July, the tax point crystallises on receipt of money. As far as revenue are concerned, what's actually been sold is a right to attend a particular event. And so as far as revenue are concerned, the performance of that is when that right was granted, which is slightly different to the special rules that apply when there has been a change in the VAT rate. Ordinarily, revenue would allow you to treat the performance date as the tax point. So if the performance actually takes place during that period, the 5% applies. Quite oddly, in this instance, revenue take the view that because you've granted a right, as far as they're concerned, the 20% VAT applies. Now, you may think it's worth making representation to revenue in order to see if that's actually right or not. The downside of doing that, of course, is if you do manage to get a 15% reduction, the unjust enrichment rules kicking, which would mean that you'd have to pay that money to your customer in any event. So whether it's worthwhile or not going back is a matter for the individual organisation. On the positive side, tickets that are actually sold during the 15th of July to the 12th of January for events that are taking place after the 12th of January will all be liable to VAT at 5%. And again, that's because a tax point will crystallise. Surprisingly, there are no anti-forestalling provisions to stop organisations doing that. So if you're selling tickets now for events that take place after the 12th of January next year, and you're not in the cultural exemption, then the 5% VAT applies. If you've got admission fees or tickets that are sold where there's an incidental supply of goods, for example, if you're going on a pub tour, on a brewery tour, and as part of that tour you're given a pint of beer, the 5% applies to the whole lot. The goods are seen as incidental. One other area that you might want to consider is where you have membership subscriptions or supporter schemes, where as part of one of the benefits that you get is the right of admission. Now this can be a complicated area because revenue normally take the view that there's a single supply of services there, and the VAT liability of that supply is dependent on what the primary benefit is. So if the primary benefit is actually the admission, potentially there's an argument there that the 5% should apply to the whole lot. I have to caveat this and say that this is very fact specific, and revenue might challenge you. So if there's any debate about the benefits that you're supplying, and if in particular there's more than one benefit, you might want to get a written ruling from revenue if you want to apply the 5%. The 5% will also apply to hospitality. So all supplies of food or catering in restaurants, cafes, pubs, and again, non-alcoholic drinks, unfortunately, they remain liable to VAT at 20%. But all food and other drinks is subject to the 5% rate. The 5% will also apply to hot takeaway food and hot non-alcoholic drinks. Cold takeaway items, i.e. cold sandwiches, salads, they remain at 0%. And we all know the fun and games we have about the VAT liability of hot and cold takeaway food. We go back to Pastygate a few years ago. Any food and non-alcoholic drinks supplied as part of a catering event or a conference, again, that's at 5%. This week, Monday, we had the introduction of the Eat Out to Help Out scheme. And this entitles those who are visiting these restaurants, and it's restaurants, cafes, etc., who have registered for the scheme, and that's the important point. They need to be registered. But there's a 50% discount on food and non-alcoholic drinks of up to £10 if you visit those establishments between Monday and Wednesday up until the end of August. If there's any cultural heritage venues or any charities that provide or have premises that provide dining, again, provided they've registered, they can also avail themselves to the scheme. Registration for the scheme did actually start 13th of July last month, and as I say, it goes on until the end of this month. If your organisation has registered for this scheme, they'll get reimbursement for the discount provided from government. As far as the VAT position is concerned, you must still account for VAT on the full value of the meal, not the discount that's offered. Effectively, you're making your supply, you've got your fee for that service, and you're getting part payment from the punter and part payment from government. So you're still getting paid for the full amount. Therefore, you still have to account for VAT on the full sum. Moving on to accommodation, the 5% rate applies to hotels, bed and breakfasts, similar establishments such as hostels, holiday cottages, campsites, caravan parks. If you've received deposits for accommodation or catering before the 15th of July, under the special rules that allow you to apply the reduced rate when the service is actually performed, if the service takes place between the 15th of July to 12th of January, you can apply the 5% rate. compare that to the position revenue are taking in respect of tickets, and you can see why there can be confusion out there. If you've actually issued a tax invoice because your customer is another business, if you're going to apply the reduced rate, then you have to issue a credit note for the 20% VAT that's been charged and refund that to the customer within 45 days. If you want to look at that, how you do that in a bit more detail, I've given you a reference there to Revenue's guidance in Notice 700. Now, all of that sounds great, but if you take a step back and think about some of the administrative issues or problems that you might encounter with all of this, many of you will have EPOS till systems, you'll have online booking agents, online booking engines and back office functions that will need to be amended and adapted to take account that now the VAT is no longer 20%, it's 5%. Similarly, if you're raising sales invoices or you've got till receipts that you're giving out, they'll have to be amended. And then you've got the question to ask yourself, are you actually going to reduce your prices, or are you going to keep your prices the same and benefit from the reduction in the VAT rate yourselves? There's no legal requirement as to what you want to do. This is a commercial decision. And there is part of government that takes the view the whole idea of this isn't just to help Joe Public, but to help businesses that have been finding themselves with lack of money over the last few months. But that's a commercial decision for individuals to take. You must remember that if you make changes to your till systems, etc., when we revert back to the 20% rate, all of that is going to have to change back to the 20% in time to have accurate reporting. And as I say, the VAT return periods fall slap bang in the middle of the adjustment period, so I'm sure there'll be a few fun and games trying to sort out accurate VAT returns. For any businesses that operate special retail schemes, you may have to look at those and consider whether or not there are any special adjustments that need to be made now that you've got a 5% rate coming in, as well as your normal 20% rate. Okay, so that's a general update on the 5% and the introduction of that. I now want to move on to the cultural exemption, and I really want to have a little refresher of when you can actually apply the cultural exemption, how you can break it, and the importance of continually monitoring how you've broken the exemption. So if we look at what the tests are for the cultural exemption, what the conditions are, the exemption applies to admission charges by a public body, so you're looking at local authorities, government departments or non-departmental government bodies, or eligible bodies, to museums, galleries, art exhibitions, zoos, theatres, and musical or choreographic performances of a cultural nature. Now, the one I want to focus on is an eligible body, because that term eligible body, although most of you may think just encompasses a charity, yes, a charity can be an eligible body, but there are various conditions that have to be met. First of all, it has to be non-profit making. It has to be able to demonstrate that it applies any profits or surpluses made from its exempt admission fees to the continuance or improvement of those facilities. And then thirdly, and this is the important one, it has to be managed and administered on an essentially voluntary basis and by people who have no direct or indirect financial interest in the activities of the body. So they're the three tests that you have to satisfy if you want to fall within the cultural exemption. Now, the downside, of course, of making exempt supplies is if you're making exempt supplies, you can't reclaim VAT on associated costs. And so therefore, some organisations take the view that rather than making exempt supplies of admission, they want to break the exemption so that their admission fees are standard rated, thereby allowing them to reclaim VAT on associated costs. This normally comes to the fore when there's some kind of major refurbishment going on in terms of the building that you're operating from. You know, the only way you're going to get the VAT back on those refurbishment costs, particularly if they're substantial, is if you're making taxable supplies. And so if the admission tickets are exempt, there isn't going to be very much VAT recovery. Now, there are a number of ways of breaking the cultural exemption. And I've listed out the more common ones there. The first one is to appoint a member of the salaried executive to the Board of Trustees. Another one is maybe to use the services of a company that might be providing you with advisory services where there's a trustee or a major shareholder on that particular board of that company. A third one, which is slightly more difficult, is actually to demonstrate that you've made a surplus or a profit from your cultural activity, and then you've taken that surplus and used it to fund something else, for example, funding your catering activities. As I say, that's a bit more of a difficult one because there's no prescribed way as to how you measure whether you've made a profit or not. And then the fourth one there is to structure in such a way so that the entity granting admission isn't the charity, but it's actually the trading subsidiary or a trading company. That one there again is more administratively difficult because there's lots of issues to consider. You need to make sure the subsidiary has the wherewithal to be able to grant admission in the first place. And I've no doubt that there may be issues or there may be questions that you need to might be able to run through with the Charity Commission. But they're the four ways you might want to consider. Now, if you implement any of those structures, it's very important that you monitor whether you satisfy and continue to satisfy the conditions for breaking the exemption. And the reason I'm raising this is because in the last year or so, I've come across a few instances where organisations have been caught out by not monitoring the basis that they've broken the cultural exemption and accidentally falling back into making exempt supplies. And that could result in quite a large liability. I've got one particular client who has a huge VAT liability because they didn't notice that the salaried exec who was on the board of a company that they were using for services they'd stopped using that company's services, and so therefore the exemption no longer applied. You could also have a situation where the chief exec who might be on the board suddenly resigns and what you're doing is you're using interims on a short-term basis until you find a replacement. But that's all well and good if that goes on for a few months, but if that goes on for a year or longer, suddenly you've got 12 months potentially where you're not in the cultural exemption any longer, and revenue will come along and say, well, your supplies are standard rated and therefore you need to work out what the net position is. Sorry, your supplies are now exempt and therefore you need to work out what your net position is now that you can't recover your VAT. If you've been undergoing large refurbishments and incurring large amounts of VAT that you've been recovering, well, that could result in a large assessment for you. Similarly, if you're using surpluses that you were demonstrating you were generating surpluses or making profits and you're no longer able to do that, again, you fall back into having to exempt your supplies. Now, the other knock-on effect, of course, if you're suddenly making exempt supplies and you've incurred capital expenditure, you suddenly find yourself having to make capital goods scheme adjustments. And so again, where in the past you've recovered all the VAT you've incurred on your costs, if you're suddenly making exempt supplies, the capital goods scheme kicks in, which does have a 10-year adjustment period. So again, there's a potential exposure there. As I say, I thought I'd talk about this because this is something that's so easy to overlook, and you could accidentally find your organisation falling back into the exemption unless you're constantly monitoring. And so what I would suggest to those of you listening here is if you've broken the cultural exemption by any of those means that I've listed there or by any other structure that you've been advised to use, please can you monitor this annually so that you don't fall foul of falling back into the exemption without realising it. Okay, let's move on to the Royal Opera House case and the recovery of VAT on their production costs. We just refresh our memories here. The question of the cultural exemption and the recovery of VAT and production costs, it seems to have been around for a long time. So in the past, revenue always took the view that production costs or exhibition costs were always directly attributable to the grant of admission. And so therefore, if the ticket sales were exempt, revenue always took the view that production and exhibition costs the VAT incurred on those costs can't be recovered because they directly relate to an exempt supply. Well, this was challenged over the years, and in particular by Mayflower Theatre and Garsington Opera. You know, in Mayflower, they successfully showed that they actually made zero-rated supplies of programmes. In Garsington, they successfully showed that some of their events were being sponsored and were generating taxable income. As a result of those cases, revenue changed their policy and they issued a business brief many years ago accepting that VAT incurred on those types of costs could be partly recovered. Now, many organisations use the standard method based on turnover to work out what proportion of the VAT they can reclaim. But revenue took the view that actually if you just use the standard method where all of your taxable income is included, that produces a distortive result. Revenue take the view that income, let's say from bar and catering, has absolutely nothing to do with production costs. So therefore, why should you benefit from that taxable turnover in your VAT recovery calculations? And so therefore, you have to consider something called the standard method override. And you know, broadly that says that where the difference is substantial, i.e. more than £50,000 of residual input tax by comparing the standard method to an alternative method, you have to apply the override and broadly apply a sectorised calculation to work out how much of the VAT you can recover on your production costs or your exhibition costs. Now, in practice, that broadly means that instead of recovering, let's say, 50% of your VAT, you normally recover half of that, because when you do this sectorised calculation, there's lots of taxable income that you leave out of those calculations. As I say, the typical one being your bar and your catering income, but it can include income from gift shop or ice cream sales as well. Revenue take the view you should do a calculation where that kind of income is omitted. Now, following more recent case law, the Royal Opera House took the view that actually the tests have changed and they lodged an appeal. Now, again, by way of background, there had been another case involving Chester Zoo where the same principles were considered, but in respect of exhibition costs. And Chester Zoo successfully argued their case in tribunal, but Revenue never appealed it. Revenue parked it to one side and took the view that Chester Zoo succeeded very much on their own facts. So we had a good few years before Royal Opera House decided to challenge the position all over again. And Royal Opera House relied on ECJ law. There's a case called Sveda, and they also relied on a case called Associated Newspapers. With Sveda, it was all about admission to a Lithuanian nature park where there was free admission, and then when you got to the top of this hill, you're able to buy teas, coffees and gifts. So there was taxable supplies there. And with Associated Newspapers, the question was whether by issuing free vouchers, taxpayer was able to still be able to recover their VAT. The Royal Opera House submitted a retrospective claim on the basis that they should just be applying the standard method with no override. And unsurprisingly, Revenue rejected the claim. Opera House appealed to the tribunal, first tier tribunal, arguing that their catering, bar income, sales of ice cream and some of their gifts and commercial venue hire should all be included in their partial exemption calculation. And the test that should be considered is one of looking at the organisation as a whole and what the economic use of the costs were. What Royal Opera House was essentially arguing was that the income they were generating from things like bar and catering were ultimately being used to fund the cost of their productions. And so you had this virtuous circle where you had production costs, productions attracting visitors, and the bar and catering income then being used to subsidise the productions. case went to tribunal, and the Opera House argued there was a direct and immediate link between their production costs and that taxable income stream. They said that such income should be included in their VAT recovery calculations, and they succeeded in the first tier tribunal. Unfortunately, unlike the Chester Zoo case, in this particular case, Revenue appealed to the upper tribunal. Now, the upper tribunal, and I have to say I attended the upper tribunal hearing just to listen to what the chairman had to say. In the upper tribunal, the judge took a very detailed review of the case law, and he concluded that there were two alternative bases for establishing whether there's a link to a taxable supply. And I have to say it's the first time I come across a case where it's been set out in this way. They took the view that where the costs concerned are general costs, i.e. overheads, that there's a right to recover the VAT on the basis of a direct and immediate link with the taxpayer's economic activity as a whole. However, where the costs are attributed to a particular supply, i.e. their residual costs, then the expenses have to effectively be cost components of the specific transactions. And that's the first time we've seen it set out in that way. Move on to the next slide. Now, both the Opera House and Revenue agreed that the production costs were residual costs and not overheads. And the upper tribunal concluded that the production costs only had a direct and immediate link to the supply of tickets, and so therefore they lost their case. The upper tribunal took the view there was absolutely no link between a production cost and the catering and bar income. So therefore, when the Royal Opera House undertakes its calculations, as far as the upper tribunal is concerned, it can't include that kind of income, i.e. bar and catering income, in its apportionment calculations. Now, understand that the Royal Opera House has appealed further. So this case is now going to the Court of Appeal, and it will be interesting to see whether we finally get some clarity from the Court of Appeal and confirmation as to whether or not actually what we need to consider is the economic link test rather than the direct and immediate test, which is what the upper tribunal has concluded. So unfortunately, it's a question of watch this space. The only final thing I would say about the Opera House case, I do have this horrible feeling that regardless of what the Court of Appeal decides, Revenue may still take the decision that each case has to be determined by its own facts, but let's wait and see. Okay, VAT updates at the moment. I'm going to quickly touch on, I hope we can't hear that coming through. It's a telephone call come through on my computer. COVID, I want to touch base on some cash flow considerations you might want to think about during the COVID, an update on e-publications, and finally an update on digital advertising. Okay, so with regard to the COVID issue, there's lots of organisations that are currently closed, not able to trade. So what we want to think, there are various things that we want to think about, in particular managing your cash flow. The first thing that we might want to consider is what we do about VAT returns. Most of you will be on quarterly VAT returns. I'm expecting that if you're closed or only partially open, the level of your income has changed and the type of income you're receiving has possibly changed. However, you're still incurring VAT on your costs. So it may be that in terms of your VAT return, you might actually be in a net repayment position. If that's the case, you might want to think about switching to monthly VAT returns rather than quarterly VAT returns, so that you're able to benefit from the cash flow of getting those monthly VAT repayments back from Revenue. If you're raising tax invoices, again, one thing that you might want to consider is the timing of raising those tax invoices. And what do I mean by that? Well, if you raise a tax invoice at the end of your VAT quarter, regardless of whether your customer has paid you or not, you're going to have an obligation to account for output tax. Whereas if you raise your invoice at the beginning of a VAT period, at least you've got some time before hopefully you get settlement of that invoice, so you've actually received the VAT from your customer before you have to account for it to revenue. Another thing you might want to consider is, rather than raising tax invoices, is actually issue a request for payment. If you issue a request for payment at that point in time, if you haven't completed your service or supplied the goods and it's an ongoing service that you have there, if you issue a request for payment, no tax point has crystallised. A tax point will only crystallise when you receive payment. So again, that might help you with cash flow. Consider when you're reclaiming input tax. Are you recovering your input tax on receipt of a tax invoice, or when the invoice is posted, or are you waiting until you pay for it? Have a look at how you're posting purchase invoices and when the input tax is being reported in your accounting systems. Maximise any bad debt relief claims. If you are issuing invoices and a customer hasn't paid you for 6 months, you can claim bad debt relief and recover the VAT on the basis that your customer hasn't yet paid you. Consider whether it's worth moving on to the annual or cash accounting schemes. These apply to organisations that with turnover up to £1.35 million. Would it be worthwhile going on to any of those schemes? Other things to consider: if you have a trading subsidiary, or you have other organisations that you control that are separately VAT registered, consider whether a VAT group would be beneficial. That would also mitigate the potential for charging VAT on any supplies between your organisation and your subsidiary. Look at the VAT recovery method you're using. If you're using one based on turnover and you've now got drastically reduced turnover, is turnover the right one to be using? On the question of VAT recovery methods, another point you should consider is whether you're actually doing quarterly calculations and what you do during this period of time when actually you have much reduced turnover. I did have one theatre organisation who contacted me and said, we've no longer got admission tickets, so we don't have any exempt income. We've only got standard rated sponsorship income. Can we now start recovering all the VAT we incur? In theory, yes, but I'd be very concerned about doing that, because if you have any capital items there, when you start to generate exempt income again, there's going to be adjustments that need to be made. There's been very little guidance from Revenue as to what the correct approach is. My own preferred approach here is, if you've done your annual adjustment, use your annual adjustment figure. So let's say for the period ending 31st of March, use that annual adjustment figure for the remainder of the year until we get some clarity from Revenue as to what organisations should be doing about their VAT recovery methods. As I say, that could have an indirect impact on your capital goods scheme adjustments. Consider how you're attributing costs, and then obviously the best way of mitigating VAT is not to be charged VAT in the first place. So consider whether you're maximising zero rate reliefs. Okay, on the question of zero rate reliefs, a couple of things that we should be aware of and want to consider. At long last, we've finally got Revenue to make some changes to e-publications. Again, for those of you that remember, Revenue have always taken the view that the zero rate only apply to printed matter. And because of changes in technology and people moving towards e-publications, unfortunately, VAT legislation hasn't kept up to date. So e-publications had always been taken as being standard rated. Now, there were plans to finally zero rate e-publications. Well, that's been brought forward. You can now zero rate e-publications from the 1st of May, and there have been changes to existing VAT legislation laid out in Group 3 of Schedule 8 of the VAT Act. Now, the zero rate applies to digital versions of books, booklets, brochures. I've listed them all out there for you. There are some exclusions. E-publications devoted predominantly to advertising or e-books don't apply. I've listed subscriptions and supporter schemes there. Again, if any of your supporters, as part of their benefits, are getting e-publications, it might be possible to apportion an element of that subscription and make it zero rated. if you're buying in these types of services, whereas in the past you would have been incurring VAT, those services can now be zero rated. One of the big areas to think about is the reverse charge. It may have been that in the past you've applying the reverse charge to e-publications. And what is the reverse charge? This is where you're receiving services from an overseas supplier. You have to charge yourself VAT and recover it subject to the normal rules. Well, if the service is actually an e-publication, there wouldn't be a reverse charge there to apply. And then finally, let's not forget that in the background here, still bubbling along, we still have the News Corp case, where News Corp is the Sunday Times. They successfully argued that their electronic newspapers should be zero rated. Revenue have appealed. The case is going further to the High Courts, and we wait to see what that judgment means. But again, if you have suppliers who have been supplying you with e-publications in the past, you might want to consider going to those suppliers and asking them to put in place retrospective claims so that you don't miss out in the event that News Corp is eventually successful. And then finally, digital advertising. This is an area where there's been lots of debate with revenue over the last couple of years, and the Charity Tax Group has been leading the fight against revenue here, where revenue have taken the view that digital advertising and social advertising is all standard rated. The Charity Tax Group received a letter from Revenue last week, essentially accepting that actually where you have advertisements by way of search engines or internet browsing, that kind of service can continue to be zero rated. However, if you have social media advertising, so for example, where the advert is targeted to a particular individual via their mailbox, that continues to be standard rated. Now, I would suggest that you visit the Charity Tax Group website just to look at what the letter says, although I think there might be a link to on our slides here direct to the letter, because it's quite restricted as to what can be covered by the zero rate and what can't be. And I do think that from a practical perspective, we may well need some help from the suppliers before we can determine whether these zero rates apply. But this has been an ongoing battle, and after 2 years of arguing, there has been some light at the end of the tunnel. As I say, this was only announced last week, so relatively new, but one for you to have a look at. Okay, I'm sure you've probably had enough from me on VAT, and so therefore I'll pass you on to my colleague John, who will outline for you some of the gift aid issues to be considered with some of what I've spoken about. Over to you, John.
Thanks, Doc. I'll bring in a bit of light relief now from VAT and cover some of the other gift aid and tax updates in the sector. So starting with some gift aid topics, the first topic is about waived refunds for cancelled events. Of course, a lot of events have been cancelled in recent months as a result of the impact of coronavirus, not least of which in the arts and culture sector. But what happens if an event is cancelled and the person who's paid for this event decides that they're going to waive the money that they're due back as a refund and donate that money to the charity that's organised the event? There's a question of whether that qualifies for gift aid, and ordinarily, in principle, no, it wouldn't, or at least it would be, at the very least, it would be highly questionable whether it would. And the reason for this is because one of the qualifying conditions for a gift aid donation is that the donation must take the form of a payment of a sum of money. So normally what the charity would have to do is pay the money back, the refund that the individual is due, and then encourage them to make effectively a donation back to the charity again to claim gift aid on that. But helpfully, HMRC have published a concession, especially for the current environment. This only applies to events cancelled due to COVID. I should just be clear on that point. It doesn't apply to events cancelled for any other reason. It doesn't apply for events which have not been cancelled, but where perhaps an individual can't make the event because of COVID, but the event hasn't actually been cancelled. It doesn't apply to anything that's not an event. This is just for events cancelled due to COVID. HMRC have given a concession that they will accept if an individual is due a refund and they waive their right to that refund, that will qualify for gift aid without having to actually pay the money back. They do, of course, you still need to meet all the other conditions for gift aid, so they still need to make a gift aid declaration. There still needs to be some correspondence where they agree that the waiver is going to be a gift aid donation, and the charity needs to keep an audit trail to show that they can link that donation back to the waiver. But this is a helpful concession. It will help save a lot of administration. It saves a lot of donations that would be at risk, because if you pay the money back, then you're less likely to get it back again as a gift aid donation. So this should be very helpful for the charity sector during this time. And on a related note, what happens if a charity refunds a fee that they've already claimed gift aid on? And normally this isn't applicable, because normally charities can't claim gift aid on payments for events or payments for anything. But there is, as many people will know, there is a special rule for payments to view charity property. This applies in principle where a person pays either 10% above the ordinary public price for admission, or where they get 12 months of free or discounted entry, perhaps as part of a membership package that they paid to join. The effect of this is that the payment that they made to view charity property is effectively treated as though it has no value for gift aid purposes, and so in principle you can treat it like a donation, because effectively they're paying for nothing. This, I should point out, this is only a rule for gift aid. It doesn't make it a donation for VAT purposes or any other purposes. This is just for gift aid. So that's the normal rule, but amongst the other qualifying requirements for gift aid, a gift aid payment cannot carry a right to refund. So if an individual has paid say they paid in advance for an event, or they've paid for 12 months of free entry and the museum perhaps has closed 6 months into that, they are not entitled to a refund for that. They can't be, because if they were, as part of the terms and conditions, that would disqualify the original payment from gift aid. So a lot of charities may feel inclined to make refunds, even though the individuals who've paid for these cancelled events or closed museums, even though they're not entitled to a refund, as a matter of principle, they may feel an obligation to make those refunds. So there is a risk associated with this, because in effect you have a charity making a payment out of charitable funds to an individual that individual is not entitled to, and so the possible risk is that HMRC could contend that's a non-charitable payment, and if they were successful in contending that could impact on the charity's overall entitlement to exemptions from tax on its income. Realistically, it's not all that likely that HMRC would seek to contend this point, especially at the moment with everything going on. But in order to minimise the risk, it's important that if a charity is making refunds to individuals who've paid for the right to admission to view charity property, and where those individuals are not entitled to a refund, they should document the reasoning behind this and why making this payment is in the charity's interests. That in most cases should not be too difficult to do, because the main reasons would be to preserve the charity's public reputation, and also it's a goodwill gesture to donors, to incentivize them to make more donations in the future. So there should be a reasonable justification for making refund payments, but it's important just to keep that documented, just to protect the charity's position. And just moving on to one other point on gift aid. A lot of museums and galleries are starting to reopen now, and some are looking at reopening with limited openings, and some of those limited openings are looking at being just for members, that being people who've paid for a membership in which, amongst other things, they get the right to 12 months free entry, as I mentioned a moment ago. So there's a point to warn about this, which is that the special rules that apply to the special gift aid rules that apply to viewing charity property, they only apply where the entry is also available to the public. So if you're providing a private limited viewing for members only, then that doesn't qualify for being given a zero value for gift aid purposes. So you actually do have to value that benefit. That doesn't necessarily mean that the membership is outright disqualified from gift aid, but it's possible if the value of the benefit takes you over the donor benefit limits. The donor benefit limits, just for simplicity, if we're talking about up to £100 that the individual has paid for their membership, then the benefit limit would be 25% of what they've paid. And so if the benefit value of this limited exhibition plus any other benefits they've received as a member goes over that limit, then you will have to pay back the gift aids that's been claimed on those memberships. So we do have to take care on this point. But the method of valuing the benefit of providing a limited opening for members, HMRC generally agree that entry to a non-ticketed event, that's an event not available to the public, will usually be valued by taking the cost of the event and dividing it by the number of people in attendance. In practice, that may well be a relatively low cost for a museum or gallery, because you only have to account for the cost of staging that event. You don't have to include any of the overall costs of maintaining the museum or the gallery. So it may well be that the benefit value doesn't take you over the limit. But one other thing you could look at to minimize the risk is you could make these events open to the public for a fee. The fee could be a relatively high fee as long as it's reasonable, and just not advertise it to the public, just advertise it only to members. If it's available to the public, then it should still qualify for the zero value for gift aid purposes. So, and just a couple of other points on business rates. There's recently been a landmark case on business rates for the Royal Albert Memorial Museum. This was to do with the basis of measurement for rating value. Exeter City Council arguing that the museum should be valued based on the receipts and expenditure method, which is based on the museum's ability to generate a profit, and the Valuation Office Agency arguing it should be done on the contractor's method, which is based on the cost of rebuilding an equivalent property today. And this made a huge difference to the rating value, because based on the contractor's method, it would have a value of £445,000. That's essentially 5% of what it would cost to rebuild it. And the receipts and expenditure method, it had a value of £1 because it doesn't generate any profits. Ultimately, the council has been successful. The upper tribunal decision in January 2020 was to value this on the receipts and expenditure method, and that was a request to appeal was rejected by the Court of Appeal in June. This isn't an outright decision for all museums, but it's going to have major implications for museums, particularly those based in historic listed buildings. And one of the point on business rates, just going back to March, the Chancellor announced at the March budget that there will be a 100% rates discount for the 2020-21 tax year. That does include museums, galleries, theatres, live music venues, and it also covers cafes, so that will include cafes in any of those venues. So that's just covering a couple of topical other tax points based on developments currently in the arts and culture sector. There are, of course, many other things ongoing matters like museum tax relief, theatre tax relief, employment tax, corporate tax, which are also matters that we advise on. We're very happy to take questions on those in the Q&A. And back over to you, Sok, I think.
See, I'm speaking with a muted microphone. Hopefully you can hear me now. Thank you for that, John. Yeah, thank you for that, John. Sorry, I had another phone going at the same time. Hopefully that was useful. We've got a couple of minutes for some questions and answers, hopefully. I can see that there's a whole list that are coming through here. Far more than we'll be able to cope with, so I'll just pick out a couple really. Right, somebody's asking how they apply for the VAT refund scheme. Now, I'm assuming what they mean, what you actually mean by that, when you're asking about the refund scheme, you're referring to the refund scheme for museums and galleries that have free admission. There is a special relief for museums and galleries that have free admission, whereby, provided they've been approved, they can actually reclaim all the VAT on their exhibition costs under section 33A. But in order to apply for the refund scheme, there are various conditions that need to be met, one of which is that you have a permanent collection on display, and you're open at least 30 hours per week. Now, making application for this only happens periodically. I think the last time the closing date was January 2019. I'm not sure if there's a current date for new applications, but what I would do is look at Revenue's notice on this. I think it's, see if I've got my memory right, I think it's notice 998 if I remember correctly, but there is a particular Revenue public notice that outlines the conditions for the relief, and if you look at that and you feel that you satisfy those tests, then you'll probably have to make enquiries of the DCMS to find out when there's a new opportunity to make application to be included as an approved body. So you have to be approved before you can use that particular refund scheme. Okay, I'm trying to see if there's one for you, John, on this long list. I don't know if you're seeing any of these lists here. Okay, there's another one here. Probably, well, this will probably be for me. We have an approval for a special method for our VAT recovery. How does Royal Opera House affect us? Well, one of the things to remember about a special method is if you have agreement with Revenue to use a special method, the only time you can change from that method is if you get the approval from Revenue, or Revenue issue you with a special method override notice. So if you have approval for a special method, technically you can't go back retrospectively to make adjustments. Even if Royal Opera House were to win their case, you can't go back. And similarly, if you have a special method that's giving you a beneficial result, Revenue again can't take retrospective action. The only way they can do that is if a special method override notice is issued. So I think the point to consider is whether or not your special method is giving you a fair and reasonable result, and if it is, then leave things as they are. If you think you're getting an unfair result or a result that doesn't help you, then I think you need to consider whether or not you should issue an override notice yourself, because it's both Revenue and the taxpayer that can issue an override if they feel the method is no longer fit for purpose. Okay, we've been asked whether slides will be available after the webinar. I think I'm right in saying that slides will be distributed. So I think there will be an opportunity for slides and also for some of the questions to be answered. Okay, is the TTR scheme being extended to include costs for cancelled shows? Is that one for you, John? Is that theatre tax relief there?
The theatre tax relief scheme, yes, is it being extended to include running costs? Well, if it wouldn't include running costs in any event, because theatre tax relief only covers production costs. But as for the production costs for cancelled shows, I have to admit I'm not sure off the top of my head. If it follows the line of theatre tax relief, a lot of it is similar to research and development relief, which would cover cancelled developments, and so I would like to think so, but I'll have to check that one. And if you're very welcome to drop me a line directly, I can come back to you on that point.
Yeah, and as I say, I think the intention is that there's so many questions here. I think the intention is that we'll try and draw up a list of questions that have been answered, that have been raised, and answer those together with the slides that we're going to be circulating. I'm conscious of time. I'll take one more here. There's a question here. If we charge 50p in addition to a ticket price for people who purchase tickets in person, this is to encourage the people to purchase online ahead of entering the building, would that be 5% rated? Well, if the 50p, it depends how you do this. If the 50p is voluntary and it's a pure donation, then it's outside the scope. But if the 50p is actually a fee to buy the ticket, then it is just seen as further consideration for the price of the ticket. And if the ticket is at 5%, because it falls within the reduced rate period, then that 50p will also be liable to the reduced rate, because it basically forms part of the consideration. Okay, I'm conscious of time. We did say this was going to be an hour, and there's no way I can go through all of those questions with John, but we'd be very happy to hear from you separately if you want to email us. As I say, we will be publishing a list of questions and answers in any event, certainly the ones that have been raised. But if any of you would like to contact us separately, I see our contact details have come up on the screen. I'm aware that many of you are existing clients, so you'll know us in any event. For those of you that haven't worked with us in the past, we'd be very happy to hear from you and see if we can be of assistance. Otherwise, both John and I would like to thank you for your time and hope you found that hour useful and helpful for you. Thank you very much.